Nathan, welcome to Zillionaire. Thank you so much, man. Hit me up on the Discord. I'll get you added to the country club after the stream. How you guys doing? What's up? Fucking nothing all day. That's why I'm not here. I thought you would join closer to FOMC. Still too early. Yeah, I know. I was going to give people a rundown on positioning and then probably make some food. And then I'm hoping by the time I'm done with that, it'll be time for the data. Look at how overpriced options are. A little bit more to the downside. Raising rates to the moon, biatches. I don't think that's going to happen. Near the money is so expensive right now. I know. I mean, $5 range for 2 hours isn't an optimal trading environment. No, it's really not. Cheeseburger, Pepsi for me. Okay, Mike. Canada lowered interest rates 0.25. And Gamma Max calls are 600 0 DTE. Fuck that. What if Powell holds rates steady and says we're data dependent? That would be wild. That's what he should do. But Powell hasn't done the thing he should do since 2022. Also, rates are going to explode and people are going to lose billions of dollars on bonds. If Powell doesn't cut rates, he's going to accidentally fall out of a window. Huh. No. I don't really think the administration gives a shit about rate cuts. I think they care about QT. Not if you bought them front ran them a month ago. I bought calls for FOMC back in August. And then they just went in the money and I closed them. If I were Cook after getting fucking sandbagged by Plute, I'd definitely vote to raise rates. So that's one person. Loved the podcast. Oh, cool. Thanks. It's still a work in progress. And then I realized I changed the file name to something that wasn't an MP3. Whoops. That probably made it hard to play. It plays on VLC anyways. Oh, okay. Excuse me? Podcast? Yeah. I figured it out by just changing the file name to add.mp3. Yep, that works. I changed the file name because I don't want to dox the editor, but then I forgot to put .mp3 at the end of it. I assumed that was just locked in. Nope. It should play on any phone. You should be able to download it and listen to it. We'll have it on like YouTube and Spotify and Apple Music and all that shit soon. Just not yet. This is kind of just like a trial run, so it's like we didn't publicize it. It's just the pickle jar. Did you notice there was a void in the potosphere and decided to fill it? No. No, we're just roundtables are rough on everyone's schedule, so trying to move to a format that's more concise, but we can still, answer questions or whatever. Speaking of which, if you guys want to submit questions for the podcast, you can DM is it just hold on, let me double check his screen name on our Discord. God damn it. Beta admin Ron. And you can have your question featured in the next episode. No, I'm serious. Like, I laughed, but it's the file is in the announcements channel. Yeah, you can ask do puts cost same like shares, and we also reserve the right to just not fucking answer. It's pretty flat. Oh, but goddamn, I feel like I warned everyone last night that this was a very likely outcome. Wait till we get back to 6,600. That's gonna be fucking mind-boggling. What's the most bearish outcome for Carvana? I want to goon to the possibilities. Carvana looks like it bounced. Yeah, small caps are running real hard today. Probably bullish with the cut and then bearish later. If you eventually make it onto Rogan, you should just talk about Elliott waves for 2 hours. There are 20 million retail traders off the scent. mm. If meritocracy worked the way it was supposed to, all of Joe Rogan's listeners would be too poor to trade options. Upstart's been doing okay. I might actually cut it before the rate decision. Just just because I don't want to risk it. No, 1 second. All right. Yeah, I'm not saying a rate cut's like bad for Upstart. I just don't. I don't know if I want the risk. I'm like 20 contracts long, so probably probably trim a few, and then maybe I'll leave some runners in case rates do get cut. No, it's not a subscription. Just free. No, this is the most bearish thing I've heard all day. The U.S. House of Representatives to start using Microsoft Copilot. What's up, slot machine? Yeah, that's a distinct possibility. Mm. Oh. I do have pets. I went long Vega like last week. How's your $3 million credit spread doing? Shut your mouth. Hit that Discord. Oh shit! Yeah, I'll flip it on. I don't have a $3 million credit spread, Willie. That's crazy. No, there's room for us to fall down to like 80. There was actually a little bit of interest to the downside at 90 last night, so I'm sure whatever you say. Wink, wink. Hmm. Hmm. All right. Do you use SPX or TQQQ to go long Vega? SPX. TQQQ to go short Delta. Gamma? Whatever. A little bit of both, I guess. Delta sensitive and gamma sensitive. Pooties. Speaking of which. Mm, damn. Hmm. TQQQ being a bit of a weirdo. Yep, support at 90. Maybe. Yeah, I guess it could. Delta to the upside's a little bit rough. But we got room to move out to like 8 or 9. 9? Mm-hmm. That's the way to put that is if it gets to 8, it can get to 9. Ah, bitch. Mm. Mm. Starting to get a little bit of profit taking, but yeah, it still looks like bullish interest coming in. Not too bad. Why not? Anyone still short UNH today? Red pickle jar. All of Discord was hacked. All chat logs dumped. 2.1 billion threads. Damn. You think all the Discord traffic for the last 5 years hasn't been dumped into Palantir tools? You're very naive. No, doctor appointment went fine. They just I had to like look at my back, but the muscle I tore is healing, so all good. I have to do some physical therapy for like a few weeks, but I think I'm gonna be in good shape. I generally use like a medium dark roast because I don't like light roasts. I think they're gross. I like my coffee that tastes like coffee, not floral tea. But like I would say medium to medium dark, and then I don't fuck around with extraction too much. Like 1836, like 18 seconds, 36 grams, something like that. Usually 2 to 1 on like weight to output, or one to two rather. Since multiple rate cuts are already priced in, is this likely to be FOMC where nothing really moves until he's done speaking? Or the SEP QE decision be a big thing? I think the SEP and the QE decision is going to be a big deal. I actually think most of the pricing will probably be done before he speaks. We might get mean reversion though. That's usually what happens is you get like the initial reaction, and then we mean revert, and then he starts talking, and then the market picks a direction. There's an awful lot of fucking vol priced in today though, so on the bull side of things, shit could really launch because if that gets shorted into the dirt, it's going to be violent. On the downside, I mean, we can move down, but we'd need to move down real sharp for the volatility to be priced correctly. What are your thoughts on Lulu? People are fucking, like, just not as well off as they were a couple years ago. It's really hard to justify, like, $150 hoodie right now. Especially when you can get, like, equivalent quality for less money. And, oh, like, a lot of those, like, midline luxury brands rely on popularity and the ability to maintain non-discounted pricing, and they're in a weak spot when it comes to uncertainty in the economy. Luxury brands don't need to price down because they're in fact luxury brands, and then discount brands can put shit on sale and clear out inventory quickly. They can also operate on thinner margins. So I'm not sure Lulu's in a bad place. Like they could survive. I think they still make pretty decent like quality stuff, but it's definitely some risk. I have Netflix calls because they look bullish to me, but I'm unsure if I should keep them. Probably really dangerous right now. You caught a nice bounce, um, but downtrending. So yeah, I would say that there's probably some moderate risk in staying long. Mm, there might be. Let me look at something. There might be a better price target than where spot is. Yeah, it bounced like right off of GM. Um, it's up about 2% today. 225. Well, 1220 looked like resistance. Yeah, I would imagine it's probably going to get pinned around 1220. Uh, it's got a little bit of momentum on it right now, but there's not a lot of delta to the upside. And even with the gamma out to 30, it looks like that would be quite difficult to reach. But further out on the chain, there's more interest. So what the fuck is wrong with that? Oh, okay. So just the weird. That's a very high vol. Perfectly normal options pricing. It's kind of an illiquid chain. I will say Ivy picks up on the calls quite a bit above 1220. Yeah, so it could keep going, but I'd probably have some kind of stop in place to protect your downside. What are your thoughts on JPOW Color? Lavender. 833 plug 2C. Ah, nice. That's on December 19, SPX puts after Vol Crush from FOMC. I don't think they're that much more expensive prior to FOMC than they will be after. I'm sure that the like 90 plus day implied vols aren't going wild right now. Maybe up a little bit, but like 1% or something. Yeah, you can do it on QQQ. I mean, QQQ and SPY just have less leverage, so the contracts tend to be a little bit less Vega sensitive, but you can get Vega exposure on any of them. Mm. 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 Interesting. Any reason KSS is that big today? Like, all of the Russell is running super hard because of the prospect of rate cuts. Podcast racing? Oh, yeah, I saw it. Cole's cash now currently worth more than the dollar. I did know that you can, yeah, you can go like 30 minutes before it opens. Was the podcast posted with the file ending to filter out the technically challenged? No. I changed the file name and didn't realize that Discord wouldn't keep the .mp3. I could repost it with like an MP3. Hold on, I can do that. Actually, There, now you can just listen to it on Discord. Do you think opportunity on AQN from its major drop recently? Options tend to be pretty boring for it, but I was wondering if you consider scooping more shares here. Looks close to long-term support. I turned my drip on it below 555, so I guess yes, technically I would. If it's still below 555 by the end of the month, then I'll end up buying more shares. Your audio's super trippy today. Why? I don't get it. Audio's fine. Okay. Maybe it's your connection? FOMC gonna be so bullish. No? It's just gonna be whatever it is. Also, we've kind of priced in all the bullishness. So if everything comes out exactly the way bulls expect, that's largely already there. Yeah, it might be Firefox. Hmm. This podcast thing replacing the roundtable pretty much? It should, mostly. Over time. Not right away. We'll probably have a few more roundtables like post launch. Um as like new users come in, but then after that we're gonna switch over entirely. I'm fucking hungry. Do I have food here? I don't think I do. Maybe I'll make something to eat in a minute. It's a podcast. It's a it's a 1 hour long audio track. Oh look, spots clawing back towards 6,600. Who would have guessed? I said that before. I said support at 90, and then we can go back to what? Are you? Hmm. No, we don't solve any murders. Oofed. UNH got a bounce. It's a fucking 80 cents. Just caution, podcaster life expectancy is currently in a downtrend. Didn't solve any murders so far. The only murder that's going to occur on the podcast is JFresh and Dork plotting my demise in order to get my bips. We have a Highlander style chain of command. So if you kill the person above you in our corporate structure, you then gain their share of the company and also their power. It was really hard to find a lawyer that would write that up for us, but in the end we got there. Exactly. I should have used ChatGPT. I'm pretty sure my lawyer does. A tontine? Yeah, very similar to that, except eliminating other members is encouraged. What's GS gonna cost for new users? Haven't been popping on stream much, so been out of the loop. We're still trying to keep the prices the same, and I think currently we have no intention of raising them. So it's gonna cost what it costs now. Which is like the live data is like 129.99 and the overnight data is 69.99. And they're both, less if you do a year up front. I think you end up paying for like 10 months instead of 12. Sounds like a Squid Games contract. Yeah, similar. Beware the Dark Horse nuke. He has so many weapons. Yeah. Yeah, we'll try to keep those prices as long as we can. We expect the middle tier to be somewhere around like $90 when we finish it, but that's probably going to be a little while. We got a lot of data to set up before we can roll that out. When Canadian pricing, you already have that. No, Nuke didn't program a virus in my back. It's up on the dollar, but it's still worth less than the dollar. I think it's like 1 to 73 or 75 cents, something like that. Was the last time you took a vacation, Gary? Intentionally? Never. I don't do vacations. Although I should one day. Maybe. I don't know. The last time I did a vacation, I went insane. So, or well, accidentally ended up on vacation, which was I went somewhere for work and then I had to wait a week before working, and so I just found more work to do. Vacations aren't fun unless you have someone special to go with. Interesting. Yeah, I was by myself, so that wasn't. And I was in Honolulu, and that was weird. And like not during the summer or the time when people go there. I'm gonna give us some tinfoil on 2 to 3 year market expectations with all the new admin stuff from the White House. I'll restate what I said when Trump gets elected. I think he's gonna blow everything up. And it's gonna leave a power vacuum. I don't know who's gonna move into that. It's completely chaotic. Darius, welcome to Dillionaire. Thank you so much, dude. Hit me up on the Discord. I'll get you added after the stream, dude, man. No, I didn't date Mila Kunis or write a bad opera. The range for the die? Can go as high as like 66, 80, or as low as the collar. If we actually got a move, that would probably tighten up a bit, but right now, that's the range. It's a fungus threatening the world's Cavendish crop. That's been ongoing for years, though. AI music makes me sad. I know. That's because it's other people's music stolen and mashed together into something generally worse. You know what's really good? Those like blue ice cream bananas. I'm still allergic to them, but I'll eat one. They have like a synthetic version of the camembert mycelium. They've also been working on using other bacterium to produce brie, which changes the flavors slightly, but in ways that some people have found pleasant. I'm very well versed in food based pathogens, or at least pathogens that are affecting the food chain. It's very important to me to know the sustainability of my luxury ingredients. Are bananas not healthy? I mean, they have potassium. No, I'm gonna be gone Friday, but I don't think anything's important's gonna happen. Just FYI. Well, maybe not all day, but probably all day. I might get back before market close, but I kind of doubt it. I don't know everything. What do you? What? Oh, hold on one second. FOMC. Bro, the amount of time you spend researching and analyzing the stock market and have such a breadth and depth of knowledge and so much other fringe stuff. No idea how you have the time for a girlfriend or dork. Dork's far needier. That half sandwich looks nice. It's a full sandwich. I've just eaten half of it. One 115 likes, 318 watchers. Yeah, I'm not a very popular guy, Cornab. It's okay. I've learned to live with it. You run a good cult, though. Thanks, man. That means a lot. Actually, Jason, have you noticed that the rents in San Diego are just nosediving right now? What's going on there? Is it ice? Those who do like you immensely. Yeah, I went for a quality over quantity approach. Corporate buybacks dropped by 20% in the quarter. Hey, who the fuck announced that? I thought corporate buybacks were on track. Where are you getting it from? AVGO get their fucking debt upgraded today? Ooh. Market talk about an hour ago. Interesting. I feel like I read the Goldman report at the beginning of the week, and buybacks were like up this quarter, like 16% or something. Or I guess the pace of buybacks was up. So they're coming in lower than expected. I mean, maybe that's just a reaction to price. Interesting. Yeah, San Diego's like kind of the exact type of like secondary city that would get impacted by this particular type of economic condition that we currently find ourselves in. I wonder if it's going to be like the next Philly. I guess San Diego still has a large like home owner population that will remain, but Have you thought about changing your YouTube name to Charlie Gherk to get more subscribers? It's too soon. They're gonna get all upset again. Start screaming into the void. Well, Lit Spaceman just got his next stream card, so. Did they get that video taken down? Who? Mm-mm. Why is Snap vertical? Hmm. I don't know. News, I assume? Oh, it might have something to do with TikTok again. Hmm. I changed the stream card. Not out of respect for him, let me be clear. But he does have a family, so. Well, it was fun to make fun of it in the moment. I'm gonna leave it up there. Not that anyone's ever gonna fucking see it, but. I don't know where trash is, but yeah, I've got a whole bag of kettle cooked chips here. Thanks, Taco Squire. That was in bad taste, to be honest. What? I disagree. People getting shot is funny. I'm sorry you guys had to see your first violent internet video in 2025. No, it's not? Hmm. Who said? Why is it sad? We'll get more people. Pam Bondi threatened to prosecute a private employee at an Office Depot for not printing Charlie Kirk vigil flyers. How high do we run today? What? SPX? There's room up to like 6680. Because I like life and living and togetherness and friendship. Don't you want to deport all the immigrants and break up their families and destroy them? As long as they can't get the job that you want ahead of you? White life and white togetherness. I see. That makes more sense. For someone totally okay with deploying the military against U.S. citizens, you'd think you'd be more okay with violence. What's up, Farn? Fam? Just hopped in to watch FOMC with y'all. Good timing, I see. Obviously, time for a subject change. Been doing alright, Mika. How you been, man? Haven't seen you in a while. No, he said. I think he said civil rights was a bad decision. If we're gonna directly quote him. I think he was very important to a small group of chronically online people. But I didn't even know who the fuck he was. What's with people going into Starbucks and claiming their name is Charlie Kirk? I have no idea. Some kind of Spartacus thing, maybe? So I'm trying to normalize the hyperbolic and I won't have to do it, Kika. I haven't been around at all lately. What are the chances the Fed board poops in everybody's hands in 9 minutes? I'm excited for the possibility. It's less spicy than I expected it to be. Disappointing. Is J-Pow gonna quit today? I mean, that would be awesome. Then we can start blowing up our economy faster. G'day, Nick. It's okay. We'll get him next time, Taco. Everybody needs to stop being so sensitive about shit. Snowflake. Yeah. There's going to be a 75 cut to shock everyone, and mortgage rates are going to be back in the fours by Monday. If they cut 75 points today, they'd probably crash the market. Greg, you really need to know your audience more. Autistic people have big feelings. You offend me daily, and I like that shit. Me too, Danimal. You know, I didn't know him that well. Ooh, need to. I found something cool. There's a genetically modified QCAV-4 TR4 resistant Cavendish banana that just received Australian approvals last year with optionality for licensees and supply partners. Oh, God damn it. All right. Ring, 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 banana phone. Yeah, I'll stream Powell when he pops up. We've got another 30 minutes after the SEP and everything. But that'll give us plenty of time to go over the data. Oop. Fucking information's not even out yet. Now it is. So we got a 25-point cut. Not 50, 25, which is more than priced in. Median rate forecast next year 3.375, prior 3.625. Current median rate forecast 3.625, prior 3.875. Next 2 years 3.125, prior 3.375. So 5 years in, we're still looking at a long run rate of 3.125. No, it's not a recessionary cut. It's just 25 points. I will say, though, if Japan hikes now, shit's gonna get weird. I'm just gamma max on the weekly. Yeah, 680. That's about right. Well, the 150 points they had priced in by the middle of next year is gone. So projections imply 50 bips of cuts in 2025, 25 in 2026, and 25 in 2027. So one rate cut a year over the next 2 years. Is the dollar crashing yet? Front end's flat. Front end needs to come up. 14 counterparties take 13.96 billion at Fed reverse repo operation. Yep. Speaking of which, recent indicators suggest the growth of economic activity moderated in the first half of the year. Job gains have slowed and unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. Committee seeks to achieve maximum employment inflation rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks on both sides of its dual mandate and judges that downside risks to employment have risen. In support of its goals, and in light of the shift in the balance of risks, the committee decided to lower the target range for federal funds rate by 1/4 percentage point to 4 to 4.25%. In considering additional adjustments to the target range for federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance on monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations. Board of Governors of the Federal Reserve System voted to lower the interest rate paid on reserve balances to 4.15%. As part of its policy decision, the Federal Open Market Committee voted to direct the open market desk at the Federal Reserve of the Bank of New York, until instructed otherwise, to execute transactions in the system open market account in accordance with the following domestic policy directive. Undertake open market operations as necessary to maintain the federal fund rate and a target of 4 to 4.25%, conducting standing overnight repurchase agreement operations with a minimum bid rate of 4.25% with an aggregate operation limit of $500 billion. Conduct standing overnight reverse repurchase agreement operations at an offering rate of 4%, and with a per counterparty limit of $160 billion per day. Rollover at auction, the amount of principal payments from the Federal Reserve holdings of Treasury securities maturing in each calendar month that exceeds a cap of $5 billion per month. Redeem Treasury coupon securities up to this monthly cap and Treasury bills to the extent that coupon principal payments are less than the monthly cap. Reinvest the amount of principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities receiving in each calendar month that exceeds a cap of $35 billion per month into Treasury securities to roughly match the maturity composition of Treasury securities outstanding. Allow modest deviations from the stated amounts for reinvestments if needed for operational reasons. In a related action, the Board of Governors of the Federal Reserve System voted a point decrease in primary credit to 4.25%. In taking this action, the board approves requests to establish that the rates submitted by the Board of Directors of the Federal Reserve Bank, blah blah blah. Yep, no change to repo, and no quantitative easing. Euro hit 1.19. I know, along the euro, the yuan, and the yen. Feels good. No QE bearish for SPX. Not in the near term, necessarily, but I think in the long run, it's a problem. Banks are going to collapse on their unrealized losses again. Very possible if we get enough steepening in the top end of the curve. So this is a hawkish cut, theoretically. Usually futures. I don't trade Forex directly. Yuan, not Wong. Oh, I get what you're saying. I already have Vega puts. But yeah, I mean, that's what I'm doing. Whoa, whoa, you have puts? Yeah, I got them last week. I told you guys. Technically puts and debit spreads, but a little bit of both. Actually, we're not sending rates to 0%. We're sending rates to 3.25% over the next 2 years, which is, if you don't remember, significantly above the Fed's long run goal back in 2022. Our current projection is for a long run rate at 3.25%, which isn't or 3 well, I guess 3%. 50 cuts this year? Yeah, so 3%. No, 3.25. Never mind. Yeah, 3.25. I'm just long vol. I'm not like I don't care about the market or equities. I just think vol wants to go up. And I want it to go up. And I've got mm, 121 days to find out. They did share QE, QT. QT continues. Tech wrecked. It's probably not great for them. It's okay. They can just issue a bunch of debt, right? Also, alongside the government. What's up, Anthony? Welcome back, man. Also, remember with inflation, right? In March, April, inventories were loaded up, and those have been draining out over time. And this is like August, which was Lib Day 2.0. Sep. And so producers are going to have to restock inventories in order to continue to meet fairly persistent demand, which means that inflation, which moved up here and then down and then up again and then down, is going to go up again. Because that's how costs of things work. So like August CPI, PPI was lighter because there were ample inventories to absorb price shocks. The effect of the initial price shock had worn off, but we will continue to see price shocks in the future. Yeah, I am drawing shit. Fucking epic pen. There it is. What a piece of shit. There's support at 80. We'll probably just mean revert to where we were trading prior to the presser. That's generally what happens, is you get like an initial market reaction, and then you get the presser, and then depending on how the questions go, you sometimes get like a smaller one of these, and then you get like a trend. Part of that has to do with like how the arbitrage and vol is netted off. Alternatively, just wait for vol crush before buying options because they're still just overpriced. Up on the day thanks to GS. Nice, dude. Yeah, we kind of pinged right off that positive gamma. Oh look, Moran dissented his first trip to the meeting. He wanted a 50 bip cut. On RRPs down to 4% from 4.25. What a surprise! I'm not. I'm looking at the July SEP, and the differences are job gains. Job gain. So they said this time job gains slowed, unemployment edged up, still low, and inflation has moved up, still somewhat elevated. July had labor market remained solid, and said and did not say that inflation had moved up. So changing the language there. Languages for QTs the same. Continue to reduce holdings. QT caps are unchanged from July. So still 5 billion redeemable and 35 billion runoff. There's no more money in overnight repo. Gonna go slap the bank reserves for some treasury issuance. I have a question. Do you guys think that major investment banks are going to want to hold Palantir at 560x forward PE, 568x forward PE, as their margin ratios compress?
Pinches. Pinches.
Hmm.
Pinches. 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 Put their pickle in my jar, pinches. 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 Pinches.
Where else are they going to put their money?
Pinches.
Bonds.
Pinches. Pinches.
Bond returns are pretty good right now.
Pinches. 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 Pinches.
Ban Dork for writing Punchies?
5.
Wait, no. What did you do? Show me. Oh, I saw the one you mean the one you sent me yesterday? And then we were like talking about other things we could do, and we decided that doing things was hard. I liked that one. Yeah, I like yesterday. Oh, you just mean the change in at the money IV. It's
Pinchies.
absurd.
Pinchies. 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 Put their pickle in my jar. Pinchies. 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 Pinchies.
Here, I'll share it with the class.
Pinchies. 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 Pinchies.
Oh, wait.
Pinchies. 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 Pinchies.
Pinches?
Pinchies.
Thank you, Bob Ross.
5.
Pinches, 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 pinches. Hmm. You should be required by law to listen to the Ko-Fis. Nah, I muted that shit. Only you guys have to listen to them. That makes it way better. It's a good thing I don't know what margin ratios are. Wait, do you actually not? Didn't you read the books that I told you guys? What the fuck? Danimal. You would have had to have heard the stream to hear what I had to say, and so that would mean that you didn't have the stream muted. Liar. I'm personally responsible for Ko-Fi enforcing character limits in the name field after I put the entire B-movie script in there for Ko-Fi. I remember that. There's a reading list in the general chat, Gorilla Mode. Thank you. I don't read. That's what podcasts are for.
Spicy tuna roll. Put their pickle
As the
in my jar.
Punchies
As the
OG,
Punches
I take
OG,
exception to someone else
to
trading
someone
on my
else trading
name.
on my name. 5.
Oh shit, it's almost JPOW time. Hold on. We gotta get ready for Daddy. Boop. You bet there's an Indian trading guru ready to full port this. Yeah, just 10,000 rupees on red. That's because you were bullish, weren't you? Alright, so margin ratio, Danimal. Oop. Never mind.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains
That's
low,
purple.
it has
It's not lavender, though.
gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee
Holy
decided
fucking
to lower
shit,
our
4
policy interest
goddamn
rate by
years.
0.25%.
I really gotta figure out how to
We
paper
also
hand
decided
this
to
up
continue
soon.
to reduce our securities holdings.
Happy rate cut, Dave.
I'll have more to say about monetary policy after briefly reviewing economic developments.
We've had so many of them together.
Recent indicators suggest that growth of
Up and
economic
down.
activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year.
That's great,
The
right?
moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August.
So growth
that,
down,
excluding the
inflation
volatile
up.
Food and energy categories,
That's
core
so great
PCE
for our
prices
economy.
rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain
pets.
consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026
Despite there being no
and
reason to buy them.
2.1%
I
in
do have some.
2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and
That
stable
doesn't
prices
answer my
for the
question,
American people.
though.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage
Well,
point.
if you're dumb,
to
so am I.
To 4.25%, and to continue
And
reducing the size
I am.
of our balance sheet.
Just so you
Changes to
know.
government policies continue to evolve, and their effects on the economy remain uncertain.
Is J-Pow about to get
Higher tariffs
sniped?
have
No,
begun
he's
to
not at
push
a
up
school
prices
right
in some
now, so he should
categories
be
of
safe.
goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case
Hey, look
is
at
that
you.
the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead
Zing.
be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem.
He keeps saying lived.
In the
He
near
started
term,
doing it in
risks to inflation are
2023.
tilted to the
I think
upside
it
and
might be a
risks to
sign of
employment to the
dementia.
downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both
I
sides.
come here
of
to
our
lose
domain.
money, but I stay for the
With
comedy.
downside risk to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step.
Next, he's going to
towards
start
more
saying
a more
lawyer.
neutral
You mean
policy
the
stance.
correct pronunciation of the
With
word?
today's decision, we remain well positioned to
hope
respond in
so.
a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time,
TLT,
demand for
Dad.
workers has also come down quite sharply, and to the point where we see
Dad,
what I
yeah,
call a
yields
curious
at the top
balance.
end are moving
It's,
up.
You know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years.
We're waiting 3 years
you
for a
tend to do
crash.
those
Let's
at a
fucking
time
go.
When you feel
I want
policy
to
is
reiterate what
out of
Gilgamesh
place
said.
and needs to
Bro,
move
we
quickly
crashed
to a
this
new
year.
place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening. In
I'm actually
the labor
shocked
market
the
and saying,
Fed
well,
cut.
those
They
risks
don't
are
usually tighten
maybe
when
not
given
fully
a
balanced, but moving in the
choice.
direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York
The
Times.
long end
Should
doesn't
we be
matter
viewing
until it
today's
does.
cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP.
If volatility
towards more
increases
cuts than
substantially,
just,
I'll look at LT
3 months
again.
ago, with the fact that the forecast for
I actually
unemployment
traded
didn't
the
change.
dip on it.
Yeah, I think you could
like a
think
couple
of
weeks
this
ago.
in a way as a risk management
And
cut
it
because
wasn't too bad.
If you
I
look
picked
at
up
the S&P,
like
actually
5K in dividends
the projections for growth
on
this
its
year and next actually
like
picked up
drop
just a little
to
bit.
what was it like
And inflation
540 and
unemployment
like
didn't really
a
move
little
much. So
bit of
what's
equity,
different now?
not
What's
much.
different now is that you see a very different picture of the risks to the labor market. You've seen,
I think I got like
we were looking
four.
at
I ended up like
150,000
cashing
jobs
out
a
at like
month at the time of
4%
the last
upside
meeting.
or something.
And now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests
Wasn't that next
the labor
long-term
market is
play you
really
mentioned
cooling off.
writing up last
And
week?
that tells you that it's time to take that
I'm still
into account
thinking
in
about
our,
that one.
in our
That
policy.
one's a little tricky.
The SEP, once again,
Also,
the
I'm
median
not
participant
sure
has inflation
everyone can
higher
buy
than
it.
previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028.
'Cause it's RTC.
So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We
Has been
we
performing
fully
well.
understand and appreciate
No, it's not
that we
Jimmy
need
Warrens.
to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks
are
of higher
dropping.
and more persistent
We're getting
inflation
very
have
close to
probably
gamma
become
neutral.
a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from
Futures
Bloomberg Radio and Television.
6622 is the next
I'm
downside test.
a little confused by your explanation of the Fed
Then,
cutting rates because of unemployment. If you think
6600,
that most of what's happening in the
6602
employment
below that.
area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it
Keep
has to
saying
do with
risks
tariffs. That was
and
the question I was
heightened.
answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now,
There's the 6622 test, yes. Careful of a bounce.
Inflation, we continue to expect it
Also
to move up,
GM.
maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools
There's a lot
can't do two
of
things at
puts
once.
de-risking down at
What we
like
do is we ask
6,500.
which is farther from how far is it from the goal and how long is it
64.95,
expected to get to the goal.
64.85.
So and then we think about those
64.75.
things and we see.
Bot
as I
puts
mentioned,
coming
we've
at
been- our policy
65.40.
had been really skewed toward inflation for a long time, really.
70.
Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably
Picked
will
up
be
not
better for the
delivered
labor
2 large
market.
eggplant parmesan sandwiches the other day.
You see
For over
people who are sort of
$30,
more at the
their 2
margin,
slices
so
plus soda
kids
special
coming out
was
of
$9.
college and
That's
younger
expensive
people,
for bread with cheese on it.
minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In healthier
Yeah,
economy,
talk
healthier
more
labor
about
market, there would be
bearish
jobs for those
unemployment.
people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. You know what, let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time
They did
to be
25
the most
points.
likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually
Sure,
made.
pal.
So
what evidence
you will have
exists
seen
that
that we
supports a
have
monatomic
10
relationship
participants out of 19
between rates and
who wrote
unemployment?
down
If
two
this
or more
evidence
cuts
doesn't
through the remainder of the
exist,
year,
why are you
and
forcing
9
this
wrote down
fantasy
4.
on the entire
And
world?
in fact, in a good number of cases, no more cuts. So
Okay,
rather
break and
than
brattle,
looking at-
calm down.
So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes.
Are
and
calls
likelihoods
cheap?
rather than
Or
this
are
one
they
is
just
certain and
being
this one isn't
excessively
happening.
sold?
So that's what I would say.
Thank you for getting to my follow-up question.
Jimbo screaming
Is the
uncertainty and
dispersion
doubt at the
in
top
the
of his
outlook,
lungs here.
a sign
Also,
of uncertainty
we're
of
not
policy
independent.
in the meetings to come. Thank you.
You know,
What's up,
it is such
Captain
an unusual
Uncomfortable?
situation.
Yeah, crazy times. Trump wants Powell
Ordinarily,
fired.
when the labor
Unless he
market
does
is
a
weak,
100 or
inflation is
200
low.
bip cut.
And when the
Yeah,
labor market is
probably.
really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path.
Break and brattle
And
thinks
so
my
it's quite
rate
a
theories are complete
difficult
nonsense,
situation
and I
for
love him
policymakers.
for
And
that.
it's not at all surprising to me that you have a range of views. It's not so much about
Oh, look at that.
having different
Retesting gamma
views for the
neutral.
path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How
This
do
is
you
working
weight
out
them?
very well for
How
me.
worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we
Oops.
discuss.
Slipped it.
We have a great discussion.
Vega
and then
neutral.
we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And they're making their arguments, and we're having a great
Let's be
discussion
curious.
around
The only
these
puts I
challenging
bought were on
issues.
Netflix, and it's
So-
not moving at all. Why
Do you see the court
Netflix?
case around Lisa Cook
That was
as
a
being
weird
related
choice.
to questions of Fed independence?
You know,
No
I
one
see
ever
it as
cancels their
court
Netflix
case that it would
subscription.
be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But
I wonder if it could slide down
the
to
data we
50.
get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
as a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along.
belly
Economic
of the
growth is
curve's
going to be
moving up
1.5
quick.
and the 1.5% or better this
5
year,
years
maybe
up
a little better.
1.64%.
Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Ooh, Fed fund
Hi,
futures
Stephanie
are doing
Rule,
weird shit.
MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you
squeezed off the
do you buy
negative
that?
delta,
And if that is true,
There's
does
a
that
little
have
bit
implications
more to
for
the
monetary
upside,
policy setting?
So there's great uncertainty around that.
but
I
less
think
gamma at
my
6,600,
view, which is also a bit of a
6,605,
guess, but widely shared, I
probably
think, is that
just a
you are
bit
seeing
harder
some
to
effects,
move up
but it's
from
not
here.
the main
Grindier.
thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high.
Charm
We
is
essentially
just
returned
kind of
to
flat right
zero
here.
or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we
But
think
delta, gamma are both
analysts have
still
different views, but
negative
we
on
think
the
it's
daily.
contributing, 0.3
If
or
we
0.4
fall-
or something like that to the current core PCE inflation.
If we
reading,
fall
which is
under
2.9%.
90,
So
I'm
it's
pretty sure
contributing.
that
What seems to be happening is that
Yeah,
you know,
Trump turns negative again.
Mostly not being
Time
paid
is it 3 or
by
4?
exporters, mostly being paid by really the
you guys
companies
could
that
like
sit
the stream.
between the
I would
exporter and the
appreciate that.
consumer.
Thank you.
So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and
The paper reminds me
entities in
of
the middle, they'll tell you that they
flagella
have
and
every intention of
nucleoids
passing
in my
that through
11th
in
grade
time,
biology
but they're not doing
textbook.
that now. To the consumer, the pass-through has
It's okay.
been
There's other
been pretty
ones
small. It's
on
been
the
slower
spectrum
and later,
with you, Gilgamesh.
Slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with
I think it'll
Bloomberg
depend on
News.
repositioning
I just
here.
wanted to
I mean,
follow
obviously,
up,
there's still some
on,
more room to
one
the
of your
upside.
answers,
There's
just a
negative
couple
gamma
minutes
above
ago.
spot,
You know,
or
we've often
negative
heard
delta
you
above
talk
spot
about
still.
how you and your
So,
colleagues,
like, there's another,
you know,
like,
do not think about politics. This does not enter the
$15,
room.
$20 that we can
But
squeeze
one of
off
your
here.
new
The problem
colleagues,
being that
does
there's
come
very
from this
little
world,
gamma
right, where everything is seen through this
until we hit like
framework
66.10.
of
So
politics and of what party is being helped, and that person is still employed by the White House.
I'm not surprised that this is somewhat mean
how
reverting.
Can markets
Also,
and the public
initial tests of gamma
interpret,
neutral tend to be really bouncy.
You know, some of his speeches, for example, and then some of, you know, the forecasts that we see today. I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, you know, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, you know, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Yeah, secondary or tertiary tests of gamma neutral to the downside are more bearish.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting,
But
I
on
think
such
there
a
was
hard drop,
a lot
like
less
you're generally
dissent
expecting
today
near-term
than
profit
a lot of
taking,
people
and then we need to
expected.
see how positioning
It'd be
develops.
good to know
now
just
that
what you
we've
think
mean
the drivers
reverted.
were of coming to that very strong consensus in the meeting, and also on the flip side,
Given the
just
like Vana
explain
and charm
why the
flows into
dot
the end of this week,
plots
I
are
would say
really so
that
scattered
there's still
between
probably
someone
a
even
lot of
expecting
support
rates to
over
end
the
up higher
next
by the end of the year
2
to
days.
5 cuts. I mean, what were the kind of range of views you heard about on one side why there
And
was
we
so much
moved
support
like
for a
all
cut
the way down to
today,
the bottom
and
of the
on flip
implied move,
side,
so that's
why
going to
there's
drive a
so
lot of
much
put selling
divergence
as
about
well.
what comes next?
So I think there's
Both
quite a
bought
wide
and now
wide
also sold.
assessment that
Isn't this
the
SLD?
situation
SLD
has
starts
changed with
today.
respect to the labor market. Whereas we could still say, and did say
Continues through
in
Monday
July,
morning
at the
now.
time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls,
Did you take profit
it's,
on long ball?
other things
No,
as
I'm
well,
targeting like
suggests
VIX
that
20
there
or
really
higher.
is meaningful downside risk. I said there was downside risk then, but I think
I
that,
am
that
up a
downside
little
risk
on
is
it
now a
on the
reality,
day,
and
but
there's clearly more
not
downside
much.
risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut. And
Yeah, 10 years up.
some supported more cuts and some didn't. as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. You know, we endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual.
The dot plot
nature
was
of the challenges
published.
that
I'm
we
actually
face.
just not sure.
Let's remember
why
that
they
the
didn't.
unemployment rate is
Usually he brings out his little
4.3%.
iPad.
The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging.
So if you guys
to know
want the
what
projection
to do.
materials, they're
There are,
here.
as
So
I
here's the
mentioned
dot
earlier, there are
plot.
no
Since you
risk-free
didn't
paths now.
publish them.
It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that.
You too, Joshy.
Break-even rate is.
You know, so there are many different ways to calculate it, and none of them is perfect. But you know, it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. You know, it's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but you know, I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up if I may. You mentioned the downside risk to employment a fair amount, but it's
Wasn't until
striking
after
that
the
measures of
meeting
kind
to
of
get into the
activity
90-day
output for the
long vol
quarter, those that we
position.
have seem
Is
pretty
tomorrow
strong.
or
The Atlantic
Friday
Based
a
GDP
better
now is very
opportunity?
strong. You mentioned strong PC numbers as well.
Depends on how
do you
much
square
realized
those
vol,
things? Is there
like
a
how
chance
much
actually
vol
to be outside
crushes
risk to the
today.
market
I don't
if
think the
activity
pricing
actually
at
all right?
90
Well,
days is
that would be
gonna
great. We'd love that to
change
happen.
all that much.
So I don't know that you see a
Not,
big
at least
tension
not with
there, but
like
it's
intraday
gratifying to
price
see that
action over the
economic
next couple of
activity is
days.
holding.
I mean, right
You
now
know,
VIX
you know,
3
so
month is down about
it's a good bit from
2.8%
consumption. It looks like consumption
day.
was stronger than
So-
expected. What we got earlier this
Getting there.
this week, I guess. And also we're getting, you know,
As we move
a
into the
fairly narrow
AM
sector
expiry and
is
OPEX, like we
producing
might see vol pick
a
up
lot
more.
of economic activity, which is the AI build out
And then also like into next Wednesday
business investment.
and like
So,
the VIX expiration. So
you know, we watch
I would
all
say
of it, and I would say we
trying to find
you
like
know,
a
we
low
did
point in
move up
3-month vol
the median
between
for growth for this year.
like
actually
end of
moved
day
up
today and
in the S&P between the June and September.
and like next Tuesday
SEP, so,
probably.
And really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind.
Yeah, I don't know about
Barron's.
that.
Thank
If
you
we
for
get-
taking my question. Given the cumulative impact of high interest
If we
rates
slip
on the housing
90 and vol
sector,
starts picking
I'm
up again to the
wondering how
downside,
concerned you are
that
that
rejection's
current
gonna
rate levels are
extend
exacerbating
quite a
housing
bit.
affordability issues and potentially hindering household formation and wealth accumulation
There's a
for
shitload of
segment
gamma to the
population?
downside, and it's all pretty flat, so it's
You know,
easy to
housing
move through.
is an interest
Yeah, no
sensitive
problem, Bernie.
activity. So it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we we cut so aggressively
We're
in providing
close.
credit and things like that. And they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry. And
It's probably say
so
60,
rates have come down a
6550
bit,
or
and as that happens,
6600.
we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course
Maybe
raise
that just
demand.
means 80.
Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
Mm-hmm. And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reduction?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that
DF is lower too.
a visible effect on that. But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with it.
Yeah, I get one end of
those goals. Separately,
we have historic
and that's
now,
why we did what we did today. Separately, we monitor financial stability very, very carefully, and I would say it's a mixed picture. But households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So
gamma turns negative, or
granted.
charm turns
we
negative under
actually
like
assume
93.
That our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation
So
because we have risks that are both affecting the labor market and inflation.
No. Mostly
our
bot
two
calls to
goals,
the
and so we
upside.
have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. I don't. Your latter part of your question was
mostly
about independence. I
sold
don't
puts.
see
There are
market
some
participants.
sold calls there, but not
I
very
don't see
many.
that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
I think the synth long at 6,000 or 6,600 is far more important. It's like a big short strangle, 6630, 6545. That's fairly significant. Outside of that, there's not a lot near spot. We do have some bot calls to the upside, but we also have some bot puts to the downside of 6600. And most of the bot calls are like from earlier, like 6610 out to 25, and those are just kind of sitting there. There's also like a decent pile of bot puts at 6610. Like 1,500 of them or so. Yep, IV crush. Top end of the curve's still up on the day. I should listen to you about that bounce. Yeah, a little overextended to the downside. Had a pretty clear signal. Oh, a second time. Anytime you get close to this like 1-day implied move, watch out. Whether it's to the up or the downside. It does not seem that anybody's projecting that economic conditions are going to substantially improve. Snag 6000s for 4, sold off the entire way up. Nice. This is a mother of a mean reversion. There's a lot of vol to short. Like a shitload of event vol to short off. Squeeze? I mean, there's not much more to squeeze to the upside. Delta's already positive, so upside from here, grindy. There is more room to the upside. Maybe out to as high as like 30. But it'll be hard. It'll be hard to climb further. The MM's gonna, sell into the upside here pretty heavily. So without sustained and consistent upside pressure, we could pretty easily fall back towards 6,600. There's a lot of just pinning on the major strike. When's the BOJ's next move? I'm pretty sure the BOJ decision's tomorrow night. But maybe I'm wrong. Maybe tonight? Tomorrow night. Yep. Where currently zero change is being priced in. They technically don't need to hike because the Fed cut. But political pressure is a bitch. What's up? I think Bank of England tomorrow. Who's also expected to just maintain at like 4% or whatever they're at. What happens if BOJ hikes? Probably too much compression in the carry. That could be like very volatile. There's been like some hedging and carry leverage since like Tuesday. Yep, like well yesterday near close. So leverage fell off at the top end and the back and the front end, but obviously long vol demand picked up. I would say that if the BOJ hikes, we'd probably get like a volatility event. Depends on how much. I don't think they're going to. I mean, why should they? He does have an opportunity to fuck shit up. Depends, I guess, on how angry about tariffs they are. They always forecast those moves, though. Yeah, generally speaking, like 2 days in advance, the BOJ will indicate via like Nikkei news that they're going to hike rates, and that's to like push through a lot of the the volatility data or the like FX volatility that's gonna occur. U.S. tech companies announced massive investments into AI in the UK. Will they ever materialize? It's all on the corporate debt spending card. I mean, I don't know if they'll materialize. It depends. I mean, as long as there's a narrative to chase that big tech has to chase, I don't foresee spending stalling. It's just the effect of all that spending is probably not great for equities. It's going to take an excessive amount of corporate debt to build out all of that infrastructure and secure all of that energy. So much that I'm not even sure that the current numbers are possible. Actually, no, I should be more clear. I don't think the current numbers are possible. So I think those expectations are probably going to trim significantly. And if, AI continues to not yield any substantial returns, investors are not going to be, willing. Well, they're going to be more reticent to allow large amounts of debt issuance and increased capex. What is a death spiral, Alex? Came here for the sell-off. Did I miss it? I'm less bears lever up again into the end of day, probably. The chances of price getting just like hung around the major strike are pretty high. What are your thoughts on open? It's been a while. Sorry if I already brought up. I mean, it's been brought up a few times, obviously, but my thoughts on them as like a company or them just running really hard. I played like the first leg up on open and then shorted the fuck out of the first like drop from $5, but I didn't play the recent one. I don't know much about them. I know like one of their original like founders came back and like they swapped out their CFOs. I mean, as far as like profitability and stuff, they're doing okay. Margins aren't particularly great, obviously. They're probably trading at like an excited valuation right now. I would say that they're probably not worth, what are they at? Like 7.5 billion. It's a bit excessive. Why would I suggest that anybody buy anything that's up like 300%? Why would you want to buy something that's up 300%? Yeah, 18 from the low. I told everybody to buy Palantir when it was like $6. I wrote like a whole thing on it. Repo rate was brought down to 4. Are there any large positions above us? Most of the out of the money bot calls have been kind of flaking off. There's bot puts at 10 and 05. Just synthetic. I guess it's not really a synthetic long at 6,600. It's like net sold calls, net sold puts. So 6,600 probably holds. As far as pushing up above the synth short at 10, difficult. So I would say between 6,600 and 6,610 is the most likely closing range. If we slipped back below negative gamma, then there's some room to move to the downside to like 90, but that would be kind of unlikely. Gamma Strike app looks slick. I wish I knew how to use it. Well, if you go to documentation, you can learn all about it. And then if you want to know how to use it for trading, we do roundtables every Thursday night. There's about 30 of them or so from the past that you can go review if you want. The last like 4 or 5 were particularly good. Oh. Here. No. Can I share my login with my trading buddies? You'll get banned. Like your account will get banned. Unless all your trading buddies live in your house. What if we're poor and we all chip in, make more money? We don't have VPNs blocked right now, but it could fuck you over in the future. Yeah, it logs the IPs. What do you think of Spot Gamma, if you don't mind? They use incorrect data. At least we tested their service and found that several of their data points were falsified or incorrect. At least on SPX. A lot of significantly incorrect OI values, volatility is pulled directly from the exchange, not calculated locally, so the math on contract pricing is incorrect. Outside of that, I'm not really sure. Yeah, OI. We've already increased taxes on producers and importers massively. There's a free Discord bot called GexBot. Yeah, I know about it. They have a paid tier for live data. They're probably better than Spot Gamma, but GS still wins. Yeah, as far as I can tell, currently we don't have any actual competition. There's no service that's better. Not only for speed, but also data integrity. And that's because we spent 3 years building it. And we actually know what we're doing, versus a lot of these services which are kind of just like either programmers trying to make a quick buck or people with market experience that don't have any programming knowledge. You know who's better? Boom Hunter Pro. Go fuck yourself, Cornab. That's it. I'm giving one of your bips to Dork. It's not hard to figure out bot soldness of options. I just think it's not valuable. JFresh help. We already have an accountant. One second. I gotta answer this. Alright. Don't forget the services made by those with neither skill set. There's a few of those too. I use Stockwitz chat rooms for complex data analysis. I mean, I think the coolest thing about Gamma Strike is that a lot of what we've built so far is just the base layer. And the things that we're going to add to that once the infrastructure is built are so fucking cool. You won't? What? Sneak peek? There's some... Okay. What was that? Stuff we're gonna be adding. That 90 close is looking a lot more likely here. I wonder if we still close at 6,600. Slipping to negative gamma here at the end of the day was kind of interesting. Hmm. Damn, Vol got crushed so hard. What's the middle tier include? It's going to be focused on swing trading and fundamental investing. Building portfolios, managing them. Sneak peek on your thick gamma bar. Thanks, Gorilla Man. Gamble hit, 5 minute to expiry, $100. Nice. How's that different from the current not live data version? Oh, it's gonna be drastically different. The not live, like the overnight data version is very specifically focused on like people who are interested in sell side, like theta gang type strategies. So benefits people who like, you know, sell a lot of covered calls, CSPs. So what I do? Yeah, probably. I don't know. Chronos. Ding ding. Closed at 6,600. Look at that. Ah, yes, you mean smart people? Smart people, like boomer investors, you know, they don't need a lot of information. They just need the information necessary to handle the stocks and like the stocks they already own, or to manage, you know, whatever theta they're selling and whatever, you know, longer term time frames. All right. Here we are, end of day, closing almost perfectly flat. And we did get a downside move right near the market maker's expected move for the day, but we did not get an upside bounce of equivalent size. Actually, the high for the day is still near open. I would say that, you know, the effects we're seeing are, you know, still slightly bearish, although Dow and Russell did overperform a bit today, and we may continue to see some strength and breadth with the rate cut. Here on ES, obviously failed the prior week close, got a lot of strong support there, bounced off of that level, and kind of mean reverted back to yesterday's close. This is not quite a test of the downside trend, but could still turn out to be a bullish reversal. We'll have to see if, you know, weakness continues into the end of the week and the kind of longer term trend here to the downside of spot fails. But where we're currently at, I would say you would probably want to see a retest at around 66.45 to confirm any kind of downside. Dollar up on the day, which is kind of shocking, but yields at the back end of the curve moving up, kind of as I predicted, with the continuation of quantitative tightening, and yields in the belly of the curve also moving up, and even a little bit more sharply. So some steepening. Correlation on the 1 and the 3 month dropped really hard on the bounce. It was a big push into dispersion there, but then end of day kind of petered off a little bit, so maybe not a ton of confidence. Commodities, we've got, you know, gold, silver down, precious metals kind of across the board taking a hit, agriculturals taking a hit, some materials, and energy as well. So not a great day for commodities. Obviously, you know, those are all valued in dollars, so I guess kind of a little surprising that they didn't perform better. But bond volatility is probably up today, even with the downside move in correlation. Leverage on the carry trade dropped yesterday into today pretty substantially with the overnight sell-off. I can't foresee that getting levered back up until after the BOJ rate decision tomorrow. If the BOJ were to pursue a hike, which is highly unlikely given that they've given no indication of it to the FX markets, but if they were to surprise with a hike, that would be particularly damaging, and could trigger a bit of a squeeze on the yen. Skew, obviously there was some more downside protection yesterday. Today's probably about even. Nothing really exciting there. I would say that 20-day movers probably snapped back a little towards the upside with today's price action, but stocks over their 50-day moving average now falling under under the stocks above their 200-day moving average. So some of that concentration is fading out pretty quick, and I'm not really sure how much of that improved with the improvement in breadth today, but I would say things are probably still just about flat. This is kind of interesting. We continue to see a negative correlation between VX and cash VIX that is, historically significant, and at, greater levels than we saw even during like Volmageddon and, like what we saw prior to the market crash earlier this year back in Feb. So very still massively over levered into short vol there. Oop, shit. Oh fuck me. Okay, I'll figure that out. Fed fund futures, a little bit greater chance of a rate cut on the Jan contract, and a little bit greater on the March, but June fell, which is interesting. And part of that's, the dot plot revisions that project that longer run rate into 2028 at around 3.25%. So at least the further out Fed fund expectations were a bit overinflated, and the near term ones are going to be extremely sensitive to volatility. So they're going to want to price in 2 more rate cuts into the end of 2025. And if we see another big uptick in inflation, or we see a bounce back in labor, those data points are going to be particularly impactful for near term federal rate assumptions. And yeah, bear steepener picked up just a little tiny bit, not much yet, but give that time. The effect of quantitative tightening on yields, as yields dip into those bank reserves, could be pretty substantial over a longer period of time. Obviously, we got kind of like a hammer here. Fell below the 66. 2027 or whatever the fuck that is. 26.99 is the new all-time high. Didn't retest the all-time high today. Made a new low around 65.51 locally, but I would still want to see that 65.08 level, or the July high. August high? Was that the August high? Yeah, back into the August range, before there's any kind of confirmation that this is breaking down. Obviously, some of the sold puts to the downside today on that test will have some supportive effect, and then we also have a lot of positive charm and Vana flows into Friday's expiration. So even though we do have SLD, we do have quite a lot of stabilizing force in the market as well. And it may not be until after the AM expiry, when some of that supportive delta falls off, that we could see any kind of substantial drop in price on the indexes. And I did kind of want to comment on like the effects of that, like that change on margin ratios, because I know I've talked about this a lot, but you guys don't maybe understand it. So margin ratio is basically like the immediate liquidity that a bank has available, divided by like the potential margin needs or client exposure. So immediate liquidity would be like cash, or cash at the Fed, so their reserves, and then cash equivalents, which is any like level 1 HQLA, like same as cash asset, like treasuries or either financed or repo, minus any haircuts or like buffers like SLR or LRC or LCR. And so what we need to figure out now that QT is staying in place and repo is drained is where is the money going to come from to continue to finance US Treasuries, and how much of that impact is going to be shifted onto the prime dealers. Are we going to continue to see, outflows in foreign capital as the US becomes slightly less investable? If that happens, obviously pressure on prime dealers is going to increase. Many of those prime dealers also large investment banks, and globally systemically important banks as well. I think the question will be is if money market funds start rotating into US Treasuries and out of repo, which is a little bit encouraged with today's change in the repo rate down to 4%. Meanwhile, the Fed fund rate is staying at 4.25. So offering up like a little bit of a positive carry there. And so that means that if MMFs step in, the liquidity capacity of banks should be mostly unchanged because cash doesn't shrink. Actually same as cash, and cash assets won't shrink. And that means, pricing might be a little tighter if repo gets backed up, but it's fairly neutral. And then obviously somewhat influenced by continued Fed cuts or a lack thereof. And then the other kind of important outcome would be if deposits begin to fund issuance. And this is what would happen if, foreign buyers were to walk away from, or walk further away, because they already have been walking away, but walk further away from US Treasury auctions, and more of the liability fell to the prime brokers. And if that happens, reserves will fall roughly equivalent to the deposit outflow, which means that there would be like liquidity capacity would decline. And so there would be less immediate cash in the form of cash and same as cash assets, and banks would have to lean more on collateral transformation and term funding in order to finance the accumulation of that additional debt. And so with fewer reserves, they have to like hug those liquidity buffers a little more tightly, and they'll raise client margin. And if client margin costs go up, equity exposures are going to go down, because it then becomes more expensive to hold equities that have less upside potential. And so that encourages a lot of selling in the equity market. And then also, as liquidity dries up and margin rates go up, then you can start to get like repo pushing higher, and like haircuts will increase with stress. And obviously like SLR can relax, but it doesn't replace the lost cash for additional margin. So basically you get like, reserves divided by like margin need. And yeah, so that would be the like kind of the negative situation there. So we'll have to see how that develops, but obviously like not shifting to QE today is not great. But I will say that the drop in repo rate below the federal funds rate does offer a little bit of positive margin that might continue to stabilize things, at least in the near term, provided there's no shocks like the BOJ doesn't hike rates or something. All of this with margin loans at all-time highs, bullish. Actually, well, no, because if margin rates go up while margin usage is at all-time highs, margin usage will decline, right? So, and margin usage is what's propping up equity markets. there would be like a lot more incentive to shift to commodities or energy or dividend stocks or bonds. Oh, I'm sorry. I didn't realize you were being sarcastic. So yeah, so basically RRP funded issuance, minimal impact on ratios. Deposit funded issuance, really, really fucking bad. Very, very, very significant compression in those ratios. And then, you know, if we end up with like dealer warehousing with some like pressure from SLR, which they already modified to be a little less impactful, we might have some international financial issues because we're not going to meet Basel III, but margins will go up and leverage will drop, but the like HQLAs will probably stay stagnant on paper. So say that those same as cash assets will stay fairly stagnant. Just say date, strike, ticker, and direction. That's all we ask. Alright, well, at least you guys maybe learned something, or didn't. Either way, I'll fucking see you tomorrow. Later.
Kinney's Mayonnaise is a proud sponsor of Pickle Financial, so when you get a hankering for some creamy, delicious mayo after a long night of snorting, sweating, and pacing, grab some Kinney's.